Good day, fellow investors. I often get questions about how to structure an ETF portfolio. What do I think about ETFs? What do I think about this ETF, that ETF? And in this video, I really want to give you my opinions so that if you are an ETF investor, I can help you with avoiding the pitfalls that many ETF investors I spoke to in the last 7 years I see them fall into and lose a lot of money, which is one. And then also, if you're interested for more than the limitations that ETF investing provides, to really choose another route. It will be up to you. I am sure you will get a lot of value from this. So from both perspectives, no matter what kind of investor you are, always subscribe to the channel because we discuss here value investing, low risk, high reward, and that's always a benefit, no matter the investor you are. Let's start. Let's start with some ETF examples, and this is an analysis video that I made from the top 10 dividend stocks in the Vanguard High Dividend Yield ETF. And these are all great businesses, but at the top of the ETF, those are expensive businesses, and those are the most expensive now. And that is something I don't like with an ETF because you pay top price. And by paying top price, you are taking away that 1, 2, 3 percentage point returns over the long term, which is again the first negative. It is okay, you still get the 2% dividend, 3% dividend yield in this case, which is good, but it is not great, and it is, let's say, the first slight negative. However, then I also look at all the copper miners because I'm an individual stock market business researcher, and you want exposure, let's say, to copper, and you look at the copper ETF, copper mining ETF. This is not a total copper miner, 40%, now with copper down, maybe 25%. This is not only a copper miner. This company owns this company, so not that one. Tech Resources, not copper mining. BHP Group is an iron ore miner, and just this, the sixth position, is a copper miner. This is copper and gold. Okay, copper, crazy Polish company, government involvement, high taxes. Okay, copper, just a conglomerate, not copper. Okay, copper, zinc, whatever. And then we go into projects at something. This is not copper. So really, you buy something thinking you have exposure to copper, but at the end you actually don't have exposure to copper. And that's why I don't like also ETFs, because they market themselves to get your fee, which are low, in this case low with Vanguard, but very high here, and that is how they make their money. Just throw in something which is not actually reflective of the thesis, and that's again something you have to be very careful of. Further, on ETFs, those lead for you to trade. You look at ETFs. Okay, how can I get this exposure, that exposure, and then you usually do the wrong thing at the wrong moment in time. So just a year ago, everyone was screaming how you need commodities, how you need copper exposure. Copper prices will go to the moon. Let's buy. And nobody looked at the fundamentals. Nobody looked at the price paid. And now we are in the dumpster, and possibly even lower if we have a recession. Of course, it can rebound, but now it's a much better buy. But ETF buyers like to buy here for their allocations, for their exposures, not here, not here, here, and that's again a negative. And then you can trade, you can do this, you can do that. And when it comes to ETFs and trading, why don't we let Jack himself discuss this notion?
The chapter in my book on ETFs is called A Trader to the Cause. Trader, not traitor. Wouldn't dare say that, but it is that too. I'm bothered about ETFs. They are, think about it this way, that we have passive investment strategies, call it indexing. And there are two groups that own them, passive investors and active investors. And the traditional index funds, TIFs I call them, an acronym which has never been picked up by anybody but me in 4 years or 6 years, and ETFs, to give you that's, and ETFs are clearly passive funds owned by active investors. Active investing is trading, active investing is speculation, active investing is losing. And ETFs are a loser's game. Let me be very clear about that. We were doing some mathematics. Mike Nolan, you want to wave your hand? My good assistant who's here with me. And I should introduce my son Andrew, who's here in the first row, of course. So I was just playing some numbers games. I looked at the growth of exchange-traded funds and traditional index funds in the last decade, roughly. And they were virtually identical. They'd both grown at about 18% a year. And then I looked at the sources of that growth. And the sources of that growth for the traditional index funds, it was 65% appreciation and 35% new capital coming in. And for ETFs, it was exactly the opposite. 35% appreciation and 65% for capital coming in. You kind of know that from the press. They're very popular. They do all kinds of wild things, which I could talk about for a minute later on. But in any event, I thought, well, wait a minute, there's a message here. If the appreciation is heavily concentrated with traditional index fund, what does that mean about the returns of the two? That the returns of ETFs are considerably lower than the returns from traditional index funds. And you can measure this pretty easily. Mike does it for me. I can't tell you it's easy firsthand, but we go over the data. And it turns out that the traditional index funds have had a return during that in that period of 7%, 7.1%. And the ETFs have had a return, the average ETF, of 4.7%. That means you had your choice between a 10-year return of roughly 120%. I'm doing a little bit of this off the top of my head, or about 70%, 110%, 120% from the traditional index funds, and a return of about half that, 65%, from exchange-traded funds. Why doesn't anybody know that? Why is that news? And does nobody care? And the reality is that ETFs are probably the greatest financial innovation of the 21st century. They are probably also the worst investment innovation of the 20th century because people use ETFs badly, and the sponsorship is wild. Henry Kaufman would call them, if you were around at this meeting today, he would call them financial buccaneers. And what's the response? Ronna, what they do, open up a paper 2 or 3 days ago, we have 2 new ETFs. One is ETFs that are long electronic marketing firms and short retail marketing firms. That's an ETF. They brought it out just to capitalize on this momentary trend that's going on there. Then we have one just brought out for distillers, people that like to drink or whatever. And then we have another brought out for people that believe GOP policies will win. And of course, another one that people believe that Democratic policies, like you have your choice.
Risky bet.
It's an insane marketing game in which, do I make myself clear?
Yeah, I think you do. I think you do.
In which salesmen need something to sell. So we throw out more new red meat to be sold. It's a marketing business still, the investment business. It should be much less of a marketing business and much more of a fiduciary business, I think. I know. And it's obvious that trading is your enemy and is the investor's enemy and the broker's friend. I mean, this is not complicated. So I'm really troubled. And you see this in ETFs. The capital flows are wild, up and down, month after month. And sometimes those change in capital flows or the capital flows themselves, maybe 80 or 90%, the SPDR, the Standard & Poor's, they have their phases where everybody likes them or nobody likes them. So you look at a given month and you see let's say a $10 million inflow into ETFs, and it's 9 million in the SPDR. It's a very market-moving thing that they're very proud of at State Street, and they brag in the paper every day. It's the first time in history that any stock has turned over at 15 million shares an hour. They're proud of that. They're proud of that. Think of that. What is that to be proud of?
Well, so
And the problem is that ETFs are for losers because those trick your mind into more trading, more activity instead of just owning businesses. We have the top ETFs, Vanguard, low fees, okay, but if you buy them, you have to buy them and forget. If you start trading and then you start getting messages, oh, this ETF is interesting, this copper ETF, higher fees, then you start trading and then you're entering the loser's game. And that's the problem with ETF investors. And even Bogle rejected the chance to list the first ETFs because he said that it is a loser's games for investors and winners games for brokers. Always keep that in mind when it comes to investing, and don't make your broker rich. Okay, take advantage of the low fees, but don't be a loser. Further, traditional index funds have been challenged by sort of wolf in sheep's clothing, the exchange traded fund. Let me be clear, he says, there is nothing wrong with investing in those indexed ETFs that track the broad stock market, just so long as you don't trade them. So you don't have to trade them, but over the years, especially in 2020, when ARK ETFs started gaining traction, every ETF investor that I knew was attracted to that. We all know the end of that story. Hopefully it will rebound, but it's simply, if you are an ETF investor, you look just at stock prices going up and down your ETFs and you get tricked into the gambling game on the stock market, and therefore you have lower returns. And then ETFs say that you get liquidity, but as Jack Bogle here says, nothing is more stupid than liquidity for retail investors. Maybe you will need once a year to get your things liquid, which you can do with a traditional indexed fund and not an ETF. Speaking of liquidity, and this is the marketing, the wolves in sheep's clothing there. Look at the boom in ETFs, and those just keep booming because you just keep looking for them, you just keep investing into them, and you just want those stocks, those new ETFs, 8,500 ETFs, that's more than stocks trade on the New York Stock Exchange. That is really crazy. If we look at the performance, Jack Bogle analyzed it, rest in peace, Jack. 120% was the return over 10 years for those invested in traditional index funds. Those invested in ETFs had 65%. That's half of the return because you are more incentivized to do stupid things, not just hold the S&P 500 and get your 9, 7, now likely 6, 7% per year, but you're likely incentivized to trade, to try to be smart. You look at the stock prices, and then you get your average investor return of 3.6%. Also, people do the opposite of what's necessary. When things get bad, like now, they like to sell everything and outflows. Instead, when things are good, they really push in the money into the markets and buy something that goes higher. So if we summarize this, traditional investments fund are the way to go if you want to go for that. I'll put the link in the description below for my best strategy for the S&P 500 dollar cost averaging. I'm sure you'll enjoy that, but don't get into the trading game. Growth from capital coming in is for ETFs, not from performance. Lower returns are mathematical because you will do the wrong thing. ETFs are the best financial innovation, worst investment innovation. It's an insane marketing game. 2 new ETFs a day. Trading is an investor's enemy and a broker's friend. Wild capital flows, huge turnover. So everyone is now rushing out of funds, ETFs especially, now that the time is to accumulate more. You are not an investor if you are in ETFs. You want to look smart, but too much risk. You are paying top price, reducing long-term returns. You will get caught up into the trading game because you own a stock, not a business. More exotic ETFs will catch you. You will want some exposure to innovation, to gold, to copper, to uranium, to this ETF. Then you might want to go short, so a daily 2x ETF or something, and then you are doomed and gloomed. It is okay for the long term if you really stick to taking advantage of those, but then why not go for index funds, traditional Vanguard, low fee, put it there, forget it, and let businesses do the work for you. So I personally invest only in stocks, not ETFs, because of the things we just shared. I think I can do better, because also by investing in ETFs, you are not thinking. And if you think, only then you can take advantage of those opportunities that come here and there in life, be it real estate, be it that, being this. If you just don't think, you will get average returns, which is still good. And you will get average returns if you don't do stupid things. But I prefer to go for better. That's why we have this channel. That's why I spent most of my time researching, learning about investing, also share that on my research platform, that if you want to dig deeper, you can check. If you want to just start, you can check also our YouTube portfolio. Thanks for watching. Smash that like button, subscribe, and I'll see you in the next video.